We're going to bring in Todd Jordan. Todd Jordan is the analyst on Wynn. So the stock's down 10%. Steve had some interesting comments on the conference call.
Yeah, it was a fun conference call, as it always is. Usually it's a pro-capitalist rant, but this time it was focused internally. But the funniest thing, there were two questions that were really interesting or funny. One of them was some guy, an analyst, a respected analyst, actually asked, "What are the trends in non-Chinese baccarat play in Vegas?" That's like asking, what are the trends in, Egyptian viewership of ice hockey, right? I mean, who cares? Baccarat is Chinese, so that was funny. And then the other one was a Goldman Sachs analyst was about to ask a question, and Steve Wynn said, "Why did you upgrade our stock right before this earnings release?"
Because they did intraday.
He did, intraday. Upgrade. Well, actually, wasn't that particular analyst, it was the Asian analyst, but still, it was a funny question. It's like, why are you upgrading our stock when we have this horrible result?
Oh, man. This was but all jokes aside, for him, this has kind of been an interesting traverse. He's gone from being the capitalist to saying things like, we are in basically China, under China's control. Yeah. I mean, his whole dynamic and guidance has changed, has it not?
Yeah, I mean, at the end of the day, he's still being a capitalist. He's trying to create money for his shareholders, right? So he has to talk up the Chinese government. Yep. There's no question. I mean, you don't operate in Macau without being in favor of the Chinese government. I don't think a lot of the stuff that's going on is necessarily Wynn's management's fault. I think they're doing everything they can, and they cut the dividend, which is a big reason why the stock's down. But that's kind of their historical policy, right? I mean, they're pretty conservative. That's probably why the stock's down a lot. LVS, so I think actually had worse numbers last week because that grind mass or base mass, a really high margin business, is really suffering relative to expectations, and LVS has the most exposure to that. So their quarter was actually worse, but they didn't cut the dividend. They're maintaining the dividend. But my view on dividends, I think dividends are, you get the short-term relocation, dislocation when you cut the dividend or you add a dividend, stock goes up, goes down. But over time, it's going to track cash flows, right? And you can actually argue that buying back stock is more tax efficient than paying a dividend anyways, right? But you're going to get that hit, and that's why Wynn's getting the hit from the dividend cut, and LVS held up relatively well. But now LVS is getting hit today, because now you got to say, well, let's assess the probability that maybe at some point, we think 2016, there could be a higher probability that LVS has to actually come in and cut their dividend.
Because LVS has not yet cut their dividend. No. But at the same time, Steve Wynn last night kept saying, and it was kind of like he was speaking to all of Wall Street, as he tends to do, which is, I'm not going to lever up to pay you a dividend. That's irresponsible.
Right.
So is that effectively what LVS would have to do if their cash flows continue to deteriorate?
Yeah, they will have to do that. And they're kind of doing it to some extent. I mean, they're paying $2 billion worth of dividends. That's a lot of cash. And Sheldon Adelson owns a lot of stocks, so he's paying himself. But again, that's a big tax dislocation too with that, right? Because you have to pay taxes on those dividends. But I think that's what Steve Wynn is talking about, and he's justifying what they're doing. But if you look at their balance sheet and what their capex is coming up, they got a big new property coming up next year. It's probably the right move, notwithstanding the impact on the stock.
So you have a very dynamic situation where both Adelson and Wynn are self-interested in paying themselves a big dividend. Yeah. But Steve Wynn is saying that he has the maturity, I guess he called it, enough to do it first.
True.
Cut it.
True.
He's cutting what he's paying himself.
Right, but he's also, Wynn pays their top management quite a lot of money, and that's actually going to be, I think, a topic of discussion here, because you have this board fight going on with his ex-wife. So now people are more and more focused on what's going on with the board and how that impacts salary and compensation, and I think you're going to see some changes. I think they're going to start bringing down, especially with the results, they have to start bringing down this comp. So that could be a catalyst, a little bit of a catalyst going forward, but it is highlighting how well paid, including Steve Wynn, is at Wynn.
Now back to the stocks. This has been a group, and you know it as well as I do, obviously a lot better than I do. We see all the buy-siders asking us questions. People for the last, you've been bearish on Macau for the last 9, 10, 12 months.
14 months.
14 months.
Yeah.
Not that
March of last year,
Not that you're keeping score.
Yeah.
Not that we keep score or timestamp, but it seems to me that the worm still has not turned where people are like, how much lower can I sell it to? Everyone keeps trying to buy these former momentum stocks. Yeah. Is that going to change?
Well, it worked for 5 years. You buy on the dips, right? And it hasn't worked for the last 15 months, 12 months, whatever it is. I think until the estimates come down and until the real issues are flushed, like this whole base mass issue, I think is so big. And you had LVS report a quarter where I think buried way in their presentation online, they talked about how much that business was down, because there is no public data that tells you how much is down. It's down 21% in the quarter. Oh, that is an awful number for the highest margin segment, right? And I still don't hear a lot of analysts talking about that, although they're starting to talk around it because we get published occupancy numbers for the hotels, which that reflects base mass. Now they're talking about that. You've got visitation numbers actually went negative in the month of March, down I think 14%, down 17 or 18% from mainland China, which is the key driver. So I think people are starting to get around those numbers, but these stocks are where they were 2 years ago. I mean, Wynn's now a little bit below, or will be after today, but LVS is where it was 2 years ago. Yet the forward forecasts are so much lower, and we would argue still not low enough. I mean, even with these, this is what made the Wynn quarter so bad, was everybody cut their numbers last week after LVS reported, and they still managed to miss, right? And we're running through our numbers comparing to the street, and like we've been for the last 14 months, we are still well below the street for 15, and probably more importantly, particularly for LVS, we're lower for 2016. That to me is the bigger issue.
So that's the bottom line.
That's the bottom line. You still have analysts, growing EBITDA. Why is EBITDA going to suddenly grow next year? Same store EBITDA with all these new properties coming online and base mass just starting to crack.
So the call would be, because of that, 2016, when everyone comes to realize this, they'll actually realize that LVS needs to probably cut their dividend.
Yeah, probably cut their dividend, and just from a pure fundamental perspective, why do these long onlys and the long-term investors own this group and LVS? It's because long-term base mass growth. That's the visitation in from China, high margin. We think it's going to, everybody thinks it's going to grow for a long period of time, and now there's holes in that thesis. Whereas the last, we went 6 months ago, base mass was still growing, VIP was down, but who cares? VIP is lower margin. I want to buy this stock. I want to own it for the long term. I'm owning it because of base mass. What's the thesis now?
Yeah, exactly. There's thesis drift.
Yeah. Any casino company see, the other thing that was highlighted in the Wynn presentation and conference call was that Las Vegas is now softening, right? And this was the counter to Macau. This is a hedge fund, crowded, long. Let's buy MGM because they don't have as much Macau exposure, and Vegas is in this nice recovery. And our argument over the past 3 months, we started writing about it in February, was, well, what kind of recovery is this? Okay, you have good RevPAR, which is the room rates, okay? But it's still worse than the rest of the country. So up 5%, the rest of the country is up 7%, okay? Fine. Gaming revenues, flattish, and they're only flat because Baccarat has been so strong. Baccarat now, since February, has been dropping off.
Really?
Right? So Steve Wynn got on the call after probably 3 or 4 quarters of saying, Vegas is getting better. He actually put a real negative spin on what's going on in Las Vegas, and MGM has all this Vegas exposure. So domestically, there's some opportunities, I think, in the regional markets. We've liked Penn in the past. We pulled it off our best ideas list and investing ideas because we felt that March was going to be disappointing, which it was. Now it's starting to come back. We think April will be a little better. I think that's an okay play, PENN. But
because they have a new casino coming online.
Right, that's the big catalyst. That'll open up in June. So you actually have a growth opportunity in regional gaming for once, right? And but now you got some macro factors. Gas prices, ticking up a little bit. The consumer maybe, a little bit iffy, at least in my space, and the long-term demographic headwinds of domestic gaming, which is young people don't play slot machines, right? That is an issue we've been talking about, what, 6 years now, and it is, there's nothing you can really do about that, unless you can maybe add some skill-based component to the gaming system, but then you need the regulators to come in. So there's just not a lot to do on the long side in gaming.